Welcome back to the Williams Real Estate channel. Today we're discussing all things buying a property in your personal name versus in a trust structure. So before we get into it, I am by no means a tax accountant, financial advisor, financial planner, lawyer. I'm a property investor. This is my story. This is what I've done. This is how I've done it. We'll explain generally how pros and cons. There's always pros and cons versus buying in your personal name versus buying in a trust. Run through today, but before buying anything and setting up structures, best to get a good accountant. Personally, I've got a new accountant these days. I outgrew my old accountant, so there's levels to property investing. Once you get to a couple of properties, it'll go above the head of most accountants. So if you want help building a portfolio, buying investment properties and getting pointed in the directions of A-class personnel and a team around you, shoot us an email. We can connect you with the people you need on your team to help you set up the structures both in personal name and trusts to allow you to keep growing and building your portfolio. Because a lot of people that come to me have untapped capacity. You can go as far as buying your personal name. Once you get a couple of properties with the big four banks, you can then push the envelope into the second, third tier lenders. They'll lend you more money. You can then open up trust structures and companies to buy properties in, and then multiple companies and trust structures. So the sky's the limit, depending how hard you want to go, depending how complicated you want to make your portfolio. But for 90% of the people that I see and I'm helping are only scratching the surface of what their full capacity and capability is, because they're mostly buying in their personal name. So I'll run through this today. I think this will be very valuable information at a high level of understanding. Obviously, you're going to talk to professional tax accountants and lawyers to get legal advice. But as a property investor, I find you need to talk to lawyers, conveyancers, tax accountants, mortgage brokers. I mean, if you want to, you can go talk to financial planners. Get everyone's holistic view. And as a property investor, you need to sit in the middle of everyone's opinion and not be led down the garden path of one person's opinion, because the tax accountant will have the tax hat on, the mortgage broker will have the borrowing more money hat on, the financial planner will have, depending how high a risk tolerance they are, the financial planning hat on. So as a property investor, you need to sit in the middle, gather all the information and make a holistic decision on what is the best decision for your personal circumstances, your capital, your risk appetite, and how big you want to grow your portfolio. So with that said, we'll get into this today. Pros and cons of buying property in your personal name versus buying in a trust. I've done both. And in hindsight, I probably bought too many in my personal name. I could have probably set up trust structures earlier, but that's okay. Over time, I'm going to sell down properties out of my personal name to keep rolling into trusts and keep growing. But there's pros and cons. We'll run through firstly the difference. So when buying a property, you can simply just buy it in your personal name, put your name of yourself or your partner on the contract, sign it off. It's in your personal name as owning it in your personal name. Or you can set up a trust structure like this, which we'll explain in a little bit, where you will be the director of the corporate trustee, who is then the trustee of the trust, and the actual trust owns and holds the ownership of the property. So a lot more complicated. You can go down that route as well. So we'll go through pros and cons. So starting out, in your personal name, it's simple and easy to finance. So basically, you can put your name on the contract, obviously once it's been reviewed by the conveyancer and solicitor, and you buy that property in your personal name. easy to finance, pretty straightforward going through the banks to get your pre-approval, versus in a trust structure, there's a lot more moving parts and it's a slower process to get your pre-approval. Lower cost in your personal name. Come on the end of financial year when you submit your tax returns, it'll go into being part of your tax return as rental income. When you buy a property in a trust structure, it'll have its own tax return that will have to be submitted. So there's more work, hence more cost for the tax accountant, or more work for the tax accountant to submit to the ATO. So it comes with higher fees end of financial year. No CGT if a PPOR. So if you're buying a house to live in, there's no capital gains tax if you sell that property, if it's in your personal name. If you buy a property in the trust and you live in it as your house of residence, even if you sell, you'll be still subject to capital gains tax. Land tax threshold. So every state has a threshold where you don't pay land tax until you exceed that threshold when the property, the investment property that is in your personal name. So in New South Wales, it's about 1,050,000. Queensland, it's around 900,000 threshold. So once the land value collectively of all your properties within that state goes above that threshold, that's when you'll be subject to land tax. And in Victoria, it's 50 grand. So once the land values go above those thresholds, you are subject to land tax. But if you stay under those land tax thresholds in your personal name, you don't pay land tax. So that's the benefit of buying your personal name. Versus in a trust, you'll pay land tax from day one. There's no land tax thresholds. So again, higher holding costs from land taxes. Negative gearing. I don't advocate negative gearing. I'm all for looking for solid, positive geared properties, 6 to 8% rental yields. These days with high interest costs of around 5.5 to 6-7%. I'm even still paying 8.8%. I'm in the process of refinancing, but with higher interest costs these days, most properties, even with a high yield of 6, 7, 8%, are either slightly negative to neutral from day one. So in the early stages, if they are in your personal name, you'll get that benefit of negative gearing where you can claim back the losses come the end of financial year. When it's in a trust, I don't believe you can negative gear. It's just like running it in a company. You need to make sure that it's profitable, and if there is a loss, it is brought forward to the following years and it can be offset against income. So you can't claim negative gearing in a trust structure. First home buyers grant, so 5% deposit, no stamp duty. You can get that benefit if you're buying in your personal name. If it's in a trust, forget about it. No protection. So if you buy a property in your personal name and you get sued, it's easier for creditors to come after your assets that are in your personal name, versus if it's in a trust, you don't technically own it. The trust owns it and you control the trust. So you own nothing and control everything, as they say. So there's another layer of protection. So technically you don't own it, the trust owns it. So if you have a job or a business that there's a possibility of being sued, so if you're a doctor or if you have a company a high risk company, like a building company that's potentially you could go broke or not finish a project and be liable for damages, it's a good idea to set up these structures to have protection against creditors. Also buying multiple properties. Some people like to set up this structure for each property. So if there's ever an issue with an existing property, like a fire or such thing, and or legal liability, and there's a claim against one property, they can't then domino effect and go after your whole portfolio if you have a claim against one property. In your personal name, there's pretty much no protection. So next on the list is restriction or restricted borrowing capacity in your personal name. So when you buy in your personal name, the banks typically put a 2 to 3% interest buffer on the interest rate. So if the current interest rate is say 6%, you would get assessed based off your borrowing capacity at 8 or 9%. They also shave the rental income. So they typically only take up about 70 to 80% of what the actual rental income is. So they put these buffers in place when it's in your personal name. When it's in a trust, they take it on face value. So they just take whatever the interest you're paying, the full rent. So your serviceability will go further in a trust structure. So pros and cons for both. When talking about a trust, the basic structure of a trust includes a director, which is you personally as the director of a company or a corporate trustee, which this is the trustee of the trust. It's separate to the trust, so again allows another layer of protection in the event that someone is sued. There's a layer of protection there, and then the trust is then set up underneath the corporate trustee, which then holds the property. You then buy the property within that trust, and every year when you do your tax returns, you will need to disperse the profits out of the trust. So after all the income comes in, all the expenses go out, so the interest, maintenance, upkeep, insurance, property management, everything, the profit, the net profit is then dispersed to, depending how you set it up, it could be a unit trust, which is to the unit holders. So there might be, say, 2 people in the unit trust, 50% share as an example, or it could be just beneficiaries. So a discretionary trust where it's up to the discretion of the directors as the trustee to work out who gets what. So there could be, as an example, 3 children or as beneficiaries, and it's up to, could be a discretionary trust where it's up to the discretion of the trustee to work out who gets what amount. So it's more flexible, being a trust that is a discretionary trust versus a unit trust. You can also have a hybrid, which is how this is set up, where you can have both, a portion where it's unit holders and then a portion where it's also beneficiaries. The way I've personally set it up is I have set up the company as the corporate trustee. My wife and I are the directors, and then we have bought property within the trust, and we just have beneficiaries. We don't have unit holders, and the beneficiaries can be people, so it can be people in your family. So as an example, our children are beneficiaries, plus myself and my wife are beneficiaries of the trust, so it can receive the funds. And also I've got Pty Ltd, so a company. So you can also set up a company to be a beneficiary, so then you can minimize your tax to 25%. So these are all things you can discuss with a tax accountant. This is just very general, high level of how I've done it. I've done both. I started buying in my personal name to get all these benefits: simplicity, low cost, no capital gain on PPOR, the land tax thresholds. Once you've got multiple properties within the state, you end up hitting your land tax thresholds, and then once you go above them, you'll be subject to land tax anyway, at which point it then does make sense to start buying them in a trust. Once you've bought your first property and you use the 5% no deposit 5% deposit, no stamp duty, no LMI. Once you've used that grant, then you won't keep getting it. And then as you keep growing bigger and bigger, it's always good to get protection to protect the assets. Also, tax minimization strategies where you can move the profits around through the unit holders or beneficiaries or into a company every year, and less restrictions on borrowing capacity. So once you max out a trust, and for example, you may have one trust with CBA bank, so one bank per trust. Some people like to buy one property per trust. Personally, that's a lot of admin, a lot of costs come end of financial year. My strategy is I'm going to keep lumping them into one trust until the trust is maxed out, and then create another one. You can create a second one by way of a second company, again, to create that second trust. Some people like putting one property in each and having it separate. What I'm looking to do, for simplicity, I'm a simple person. I'm going to keep the same corporate trustee and then just hook additional trusts under. So trust 1, trust 2. Continue to keep, you can create 10 plus trusts. Once you're maxing out a certain trust with one bank, because typically one bank will only lend to one trust. They want to see what's all within that trust structure. Once the bank says no more, then you can go to ANZ. ANZ, and so on. And you just need an accountant letter to say that the trust is self-sufficient, and that is sufficient for the bank to lend you more money. You just need to raise capital to put into the trust. So you can lend that money personally or from a company into the trust. So you may either refinance a property in your personal name. So you may have a property in your personal name and refinance, say 200K as an example, into the trust. And then once that trust, which is another bank account, has that money in the trust, and the banks will leverage up and lend you money to buy an investment property subject to the deal. Typically it's on the deal. I want to see a strong yield, 6 to 8%. So I'm looking to buy, moving forward, everything in trust structures and lending money personally into the trust, but also through my company into the trust. So then it's can be paid interest back to us personally as cost to the trust, and income personally. So then you can keep reinvesting into multiple trusts. And once you max one out, you can create another one. The sky's the limit. You can just keep opening up more and more, depending how hard you want to go, depending how big you want to grow your portfolio, but definitely gives you that extra capacity to keep growing and leveraging and building your wealth. The other benefit too is when you hold a property within a trust, the trust is looked at on its own merits. They don't look at the banks, that is, the debts you're carrying in your personal name. So you might max yourself out in your personal name in terms of borrowing power, but then there's a separation between the debt you carry in your personal name versus the debt you've got in a trust. It is looked at on its own merit, so they can exclude the debts or the liabilities in your personal name when you're buying property in a trust. So the key is to get the capital into the trust. This can either be by way of refinancing deals out of your personal name into the trust, or selling down assets over time, which is what I'm looking to do as I continue to keep scaling up. I'll be selling all the individual units, villas, townhouses, houses, paying down the debt, raising cash, putting that money into the trust to then buy blocks of apartments in trust structures and keep growing and scaling. So there's pros and cons of both. I say how I've done it, I would probably do it again. Simplistically, I'll just start, get in the market in your personal name, get a couple of units, couple of houses. Once you get it to duplexes, blocks of units, multi-family type of property and commercial assets, best way is to structure them all in trust structures. Hope that helps. If you have any questions, shoot us an email. We can jump on a call, discuss where you're at, and see if we can work together. Until next time, thanks for watching.